Crista, thanks for joining me today.
Yeah, it's great to be back.
So another solid quarter in the books for equity markets. Excellent performance as we saw towards the tail end of last year. That really continued into the first quarter of 2024. A little less so on the fixed income side, particularly in the rates market. A little bit of headwinds there for investor returns. Before we go into the details of the various asset classes, as always, I'd like to start the conversation by just sort of painting a picture about the state of the economy. How has macro data held up over the last quarter?
Overall, economic data has come in better than expected. Global manufacturing seems to have rebounded at the end of last year. We've seen that in global PMIs where almost every region is improving. This is especially true in the US, where the manufacturing sector actually seems to be growing again. ISM is back above 50. Industrial production has rebounded. If we take even a sort of closer look at the US, employment markets are strong. The economy is adding over 300,000 jobs a month. Consumption remains robust. Housing has improved. It seems, at least on the surface, that any slowdown caused by rates has been minimal so far. And that was really evident with the GDP numbers. So we just recently got Q4 GDP, and that came in over 3%. In Canada, it's a similar story. Growth has improved over the quarter. It did have a much weaker starting point than in the US. Q4 GDP in Canada came in at 1%. The other difference between Canada and the US is, unlike in the US where consumption remains strong and the consumer remains robust, consumption in Canada continues to be weak. So overall, from a growth perspective, things continue to come out better than expected. Globally, inflation also continues to improve as sort of the year-over-year numbers continue to come down in most regions. I think the one exception there is the US, but maybe I'll start with Canada. Last year, I would characterize the inflation picture in Canada as being sticky. Short-term measures were bouncing around 3 to 4%, and core ended the year at 3.5%. This year, and sort of this quarter, we finally started seeing real improvement on the inflation side. Over the quarter, the Bank of Canada's core inflation measures are running between 2 and 2.5%. And headline is now back inside the Bank of Canada's target of 1 to 3, sitting at 2.78. So we've seen real improvements on the inflation side in Canada. In the US, it's a bit of a different story. Over the quarter, inflation in the US is actually running over 4.5%. This moved the year-over-year level up from 375 to 380. It's a small increase, but it ended the downward trend that we had been seeing for a while. And given the short-term numbers are quite a bit higher than expected, we expect to continue to see those inflation numbers move higher over the next few months.
So given the macro backdrop that you've painted, how would you characterize, again, you don't have a crystal ball, but nevertheless, you do have to sort of think through potential implications of this macro data on central bank policy. What is your sort of read right now for the central banks and how they're interpreting the most recent data?
Stronger data in general has started to cause central banks to be more cautious around when that first cut will be. A theme we've consistently heard from central banks is that they want to be confident that this higher inflation environment is behind us. And that's because they see the risk of easing too soon and causing another sort of wave of inflation as being much greater than the risk of easing too late and seeing growth deteriorate. And I think that's sort of exactly what we saw play out over this quarter. We got stronger data in the US, both growth and inflation. And this caused the Fed to revise their forecast higher, which caused them to push out the first rate hike. And you can see that with the dot plots. Although the median didn't change, the average actually did move. It went from expecting 3 cuts this year to something closer to 2 cuts. And I think our expectation is if you continue to see stronger data, we will continue to see rate cuts being taken out of the market. And unless you actually get a change in the inflation trajectory, we wouldn't be surprised if the Fed didn't cut at all this year. Something similar happened in Canada. Growth in Canada came out stronger than expected, causing the Bank of Canada to revise their GDP forecast higher. There's a little bit less pressure on the Bank of Canada, just given the inflation backdrop has been softening. So unlike the US, where growth is running below potential, growth, although improving, continues to be weak in Canada. Overall, if we think about what has changed this quarter in sort of central bank world, at least with the Fed and the Bank of Canada, it's that stronger than expected growth picture is causing central banks to be more cautious around the first hike. There's 2 other interesting developments that have happened over the quarter. One, we had our first developed market central bank actually cut rates. So the Swiss National Bank cut rates 25 basis points in March, and they're likely to continue. But inflation in Switzerland is actually running below target and has been since, I think, the middle of last year. So they really did stick to that theme of making sure that they were confident that inflation was behind them before they went on the first cut. The other development that was interesting was with the Bank of Japan. The Bank of Japan has been engaged in sort of extraordinary monetary policy for over a decade now. Back in 2013, they announced that they were going to start targeting the monetary base and effectively buying assets on a monthly basis. And not only were they buying JGBs or Japanese bonds, they were also buying the equity market through ETFs and REITs. And the goal here was to boost asset prices in an attempt to boost inflation expectations and then ultimately inflation. At the last meeting, the bank actually stated that sort of monetary easing, negative interest rates, and yield curve control have effectively fulfilled their roles. And as such, they discontinued all of these programs. So they moved from negative interest rates, so minus 10 basis points, to positive 10 basis points. They removed yield curve control. So there used to be a cap on how high long-term rates could go, and they've removed that cap. And they discontinued all of their asset purchases around equities and REITs and corporate bonds. The reaction so far has been quite muted, as I think the market did expect the Bank of Japan would start removing stimulus. However, I think this is something to worth keeping an eye on. So there's a lot of unknowns when you're unwinding policy that's been supporting certain markets for over a decade.
So you talked a little bit about where the central banks are, where they might go in terms of potential cuts, the timing of those cuts. We saw in the period, or at least in the last quarter, bond yields generally went up more or less across the curve. Of course, that led to poor performance in the asset class in the quarter. Can you just give us a little bit of context around the level of movement and what happened as it relates to bond yields?
I think over the last few quarters, the market's really been bouncing around between, this idea of higher for longer multiple rate cuts. And this quarter really was no different. We started the year, the market was pricing in 6 rate cuts by both the Fed and the Bank of Canada. Over the quarter, the market's taken a lot of that back. In the US, we're now just expecting over 1 rate cut. And in Canada, they're expecting 2. This obviously had an impact on longer term rates and rates across the curve, really. So longer term rates moved about 50 basis points higher over the quarter. The Canadian 10-year is now sitting at 365, and the US 10-year is sitting at 450.
What was the general feeling in the credit markets? And even in terms of things like new issues, where did spreads move? What was the overall tone?
I think the story over the quarter in credit space was both global growth is improving and inflation is moderating. If you think about the end of last year, central banks had signaled that they were done raising rates, meaning the next move would be a cut. And now keep in mind, central banks aren't cutting because they're worried about growth and they're not worried about a recession. They're cutting to get back to more normal level of interest rates or a neutral level. And this is a very good environment for risk assets when you have growth improving and policy easing. And that's exactly what we saw in credit space. Credit spreads are tighter on the quarter. In Canada, they tightened around 15 basis points. So the average spread in Canada is 125 basis points or 1.25%. We had sort of record issuance. There was almost 44 billion issued in Canada in the quarter, which is about 61% ahead of sort of where we were this time last year. We saw something similar in the US, both investment grade and high yield spreads were tightening. And what's interesting is US spreads are actually back at all-time tights. So they're back at pre-pandemic tights, which was a very similar level to the sort of 2006, 2007 tights. All to say there's a lot of good being priced into credit markets right now.
So that sounds like a fairly similar story as the sort of equity markets. Very strong quarter overall. Pretty much a continuation of the theme that we saw kind of throughout 2023, technology-focused businesses doing particularly well, especially if they had some sort of tie-in to artificial intelligence or semiconductors. If we look at our own portfolios, companies like TSMC, so Taiwan Semiconductor, which produces, of course, semiconductor chips, as well as ASML and ASM International. So those are both companies that actually produce the critical tools that are used in the production of semiconductors. Those businesses did extremely well in our portfolios. Not only because of the AI theme, but of course, these businesses in particular have phenomenal competitive advantages, whether it's technological know-how, their actual reputations. They've got high barriers to entry, both because it requires tremendous amounts of financial capital to actually operate in that business, as well as steep learning curves. And then, of course, they've got great market share as a result. So that was, I would say, one sort of theme in the portfolios. And then perhaps another one that we've seen sort of ticking up of late would be defense businesses. So we own a number of them across, sort of our balanced mandate, whether it be Rheinmetall, BAE Systems, BWX Technologies. And so these are all defense companies, which, of course, given the geopolitical tensions sort of flaring up in different regions, the risk that they spread into wider conflicts, you're starting to see higher defense spending. So certainly I'd say those are some of the sort of key themes on the equity side. I guess the question that I have for you is really around, it seems like equity markets have been more or less shrugging off the rise in interest rates, so the rise in bond yields. Normally, you would expect that to not necessarily be the case. What would be your interpretation of sort of that divergence? It's almost like a reasserting of correlations. Typically, equities and fixed income move in opposite directions, but at the same time, from a higher interest rate point of view, that tends to hurt stocks. And we didn't see that in the quarter. So how would you interpret that?
We have seen sort of interest rates move back up. I mentioned they moved about 50 basis points higher on the quarter. It was really a function of the market taking a lot of the rate cuts out. But keep in mind, the market is still pricing in cuts. And so, if you go from 6 cuts being priced in to 3 cuts being priced in, it doesn't really change the overall story. The overall story is growth is improving. Central banks are going to ease. Having said that, if you go from 3 cuts to 0 or potentially a hike, I think that does have a very different impact on risk assets, because that is a very different environment than the market is currently expecting.
So I guess putting all this together, you sit on our asset mix committee. Was there any activity in the quarter on the asset mix side, and what's the general view of the committee at this point?
One of the things we talk a lot about is just how much complacency there is in the market. We're mindful that we may not have seen the full impact of higher interest rates, and you can see that in some areas. We are seeing continued pressure in the real estate sector. You are seeing delinquencies rise in the U.S. Both credit card and auto loan delinquencies are actually above pre-pandemic levels. In Canada, you're seeing mortgage arrears slowly increasing, and we do know that a lot of the refinancing will happen over the next 2 years. So, to us, one of the risks out there is that it's not clear that the full impact of higher interest rates is behind us. Other risks we see, or things we're talking about, are, there's a lot of geopolitical risk, both globally and around the U.S. election. And obviously, there's a risk that this inflation story isn't done. Markets are effectively priced for perfection on that front. Now, having said all that, we do recognize we don't know how the world will play out. And so we look to build portfolios that are resilient across a number of scenarios. In terms of what we did over the quarter, there was no changes in the asset mix. We did trim equities back down to our target of flat, and we continue to be underweight bonds and overweight cash.
Awesome. Well, it's been great chatting with you again, Crista. Thanks for the quarterly update. Looking forward to talking to you next quarter.
Great. Thanks.